The television costs the store almost nothing to sell you, an 8% margin, maybe less. The $200 warranty they offered you at checkout? 60% margin or higher. The warranty was never about the TV. It was always the better business. The extended warranty and service contract industry generates an estimated $50 billion annually in the United States alone, according to industry analysis firm Warranty Week. Consumer Reports has stated for over a decade that extended warranties are, in the vast majority of cases, a bad financial decision for the buyer. And yet, attachment rates at major electronics retailers remain estimated between 20 and 40% of eligible purchases. $50 billion. Built almost entirely on a 3-second decision made under emotional pressure at a checkout counter. By the end of this video, you're going to know exactly how the extended warranty margin math works, which psychological trigger the entire industry is built on, and which specific product categories are almost never worth the extra money. And I'm going to give you a simple decision framework, one you can apply in the same 3 seconds the cashier gives you, that tells you when protection is actually worth buying. Stay with me. Let's define it precisely. An extended warranty, more accurately called a service contract, since it is legally not insurance and not a warranty in the manufacturer's sense, is a paid agreement to cover repair or replacement costs for a product after the manufacturer's original warranty expires, or in addition to it. The Federal Trade Commission has specifically noted that these products are typically sold by third-party administrators, not the manufacturer, and the actual claims payout rate, the percentage of premiums collected that gets returned to consumers as repairs, is significantly lower than in most regulated insurance products. The extended warranty as a mass consumer product traces back to the appliance and electronics retail boom of the 1970s and 1980s, when retailers including Sears and Circuit City discovered that service contracts could be sold at the point of sale with almost no marginal cost to the retailer beyond the sales conversation itself. By the 1990s, retail analysts were already documenting that some electronics chains generated a larger share of net profit from warranty sales than from the electronics themselves. The mechanism hasn't changed since. What changed is the sophistication of the moment it's offered to you, and exactly when your guard is lowest. The entire warranty upsell industry rests on a single, extensively documented psychological principle called loss aversion, first formally described by psychologists Daniel Kahneman and Amos Tversky in their 1979 prospect theory research, for which Kahneman later received the Nobel Prize in economics. Loss aversion describes the finding that people experience the pain of a potential loss roughly twice as intensely as the pleasure of an equivalent gain. At the checkout counter, the warranty offer is framed entirely around loss. What happens if your screen cracks, if the motor fails, if the laptop stops turning on? You are not being sold protection. You are being shown a loss you haven't experienced yet, and asked to pay to prevent a feeling, not just an outcome. The timing of the warranty offer is deliberate and precisely researched. It is presented after you have already emotionally committed to the purchase, after you've decided, after you're holding the product or standing at the register, rather than earlier in the shopping process, when you might comparison shop or research the actual failure rate of the product. Behavioral researchers call this exploiting the commitment and consistency principle, described by psychologist Robert Cialdini. Once you've made a decision, you're psychologically motivated to make choices that feel consistent with it, including add-ons that feel like completing the purchase responsibly. Saying no at that exact moment requires actively resisting a decision you've already made once. Here is the specific math that makes extended warranties one of the most profitable line items in retail. Electronics retailers typically operate on razor-thin product margins, often 5 to 15%, because prices are heavily comparison shopped online. A service contract sold alongside that product carries a wholesale cost to the retailer that is frequently a small fraction of the retail price charged. Industry analysts have estimated gross margins on extended warranties at electronics and appliance retailers in the range of 40 to 80%, meaning a $200 warranty may cost the retailer as little as $40 to $100 to provide, with the rest as pure profit. Consumer Reports has surveyed its members on product reliability and extended warranty value for decades, and its consistent finding is this. For most major electronics and appliances, the actual failure rate within the extended warranty coverage period is low enough that the expected cost of repairs, averaged across all buyers, is significantly less than the price charged for the warranty. Consumer Reports has specifically and repeatedly recommended against extended warranties on new laptops, televisions, and most major appliances, noting that most product failures either happen very early, while still covered by the free manufacturer warranty, or very late, well after a typical 2 to 3 year extended warranty period has expired. The warranty is priced to cover a failure window that, for most products, mostly doesn't exist. When claims are denied, the reason is almost always in the fine print most buyers never read at the point of sale. Common exclusions across major service contract providers include accidental damage, often sold as a separate, more expensive tier, cosmetic damage, damage from unauthorized repair attempts, and, critically, normal wear and tear, a category broad enough that administrators have discretion in how it's applied. A 2019 investigation by the Better Business Bureau cataloged thousands of consumer complaints against major warranty administrators citing denied claims, and a recurring theme was the gap between what sales representatives verbally implied was covered and what the written contract actually specified. The verbal pitch and the written contract are not always the same document. Here is what most extended warranty buyers don't know they already have. Many major credit cards, including cards from Chase, American Express, and Citi, automatically extend the manufacturer's warranty by an additional year at no cost when the purchase is made on that card. This benefit is documented in the cardholder agreement, rarely advertised at the point of sale, and almost never mentioned by a checkout associate offering a paid warranty. A buyer purchasing a laptop with a 1-year manufacturer warranty and a qualifying credit card may already have 2 years of coverage layered directly on top of a paid extended warranty being offered for an additional $200 to $300. The automotive industry has built an entire specialized sales function around this mechanism. The Finance and Insurance Office, known industry-wide as the F&I Office. After a customer negotiates a vehicle price, often over hours, emotionally drained, they are moved to a separate room specifically to be offered extended warranties, gap insurance, paint protection, and service contracts. Industry compensation data reviewed by the National Automobile Dealers Association shows F&I products can represent a disproportionate share of a dealership's total per-vehicle profit, in some analyses exceeding the profit made on the vehicle sale itself. The F&I office exists because the mechanism works better once you're exhausted. Travel insurance upsells follow an identical loss aversion timing pattern, deployed at the exact moment a consumer has just spent a significant amount of money and is contemplating everything that could disrupt the trip. Booking platforms, including Expedia and various airlines, present travel protection offers directly after the purchase total is displayed, never before. The U.S. Travel Insurance Association has published data showing that a large share of travel insurance claims are ultimately denied or partially paid due to exclusions the buyer did not review at the time of purchase. Pre-existing condition clauses, named storm cutoff dates for hurricane-related cancellations, and specific covered reason lists that exclude many of the actual reasons trips get canceled. Major appliance and mattress warranties operate on a distinct version of this mechanism, the long-tail exclusion. These products often carry impressively long stated warranty periods, sometimes 10 years or more, which sound reassuring at the point of sale. But the fine print frequently specifies prorated coverage, meaning the amount reimbursed decreases each year, often reaching a small fraction of original value by year 5 or 6, alongside strict maintenance documentation requirements that many buyers never fulfill. A mattress warranty claim, for example, commonly requires proof of a specific box spring or foundation type and documented rotation schedule, conditions a buyer typically never learns about until they attempt to file a claim. Quick pause. Have you ever bought an extended warranty and actually used it? Or bought one and it turned out to be more restrictive than you assumed? Drop the product, what you paid, and whether it was worth it in the comments. And if you've ever said no at the counter and immediately regretted it because something broke a month later, I want to hear that too. Most extended warranties you're offered at a major retailer are not actually administered by that retailer. Best Buy's Geek Squad protection plans, for example, are underwritten and administered through arrangements involving Asurion, one of the largest third-party warranty and insurance administrators in the country, also known for administering phone insurance plans for most major U.S. carriers. This structure means the retailer earns a commission on the sale with minimal ongoing obligation, while the administrator collects premiums across millions of contracts and profits from the statistical gap between what's collected and what's paid out in claims. The same actuarial model as traditional insurance, without the same regulatory oversight applied to insurance products in most states. Retail sales associates at many major electronics chains are compensated, in part, through commission or performance metrics tied specifically to warranty attachment rates, separate from and often more heavily weighted than commission on the product sale itself. Multiple former electronics retail employees have described, in industry forums and reporting, being evaluated on protection plan attach rate as a distinct performance metric, sometimes tied to bonuses or shift scheduling priority. The person offering you the warranty is very often being measured and compensated specifically on whether you say yes, a structural incentive independent of whether the product genuinely needs the coverage. SquareTrade, now owned by Allstate and Assurant, represent the direct-to-consumer evolution of this industry. Companies that sell warranty and protection plans directly online, independent of the original retailer, often at the moment you're already checking out on Amazon or another e-commerce platform. This model applies the identical checkout timing mechanism digitally. The protection plan offer appears in the online cart, immediately adjacent to the Buy button, framed with loss aversion language emphasizing accidental damage, liquid spills, and drops. The digital version removes the human salesperson, but keeps every behavioral trigger intact: timing, framing, and the emotional proximity to the purchase decision. The same loss aversion mechanism appears in adjacent product categories worth naming briefly for pattern recognition. Roadside assistance memberships, sold through AAA and increasingly bundled into car dealership financing packages, and identity theft protection services, frequently upsold at tax preparation counters and after data breach notifications, both follow the identical structure. An offer presented at a moment of heightened anxiety about a specific bad outcome, priced well above the statistically expected cost of that outcome for the average buyer, sold by a party financially incentivized regardless of whether the buyer will ever need it. It would be inaccurate to present this as universally bad advice. There are specific, narrow cases where extended coverage is genuinely rational. Consumer finance researchers generally agree the calculation favors buying coverage when three conditions are met together. The repair cost, if the product fails, would be genuinely difficult for you to absorb financially. The product has a documented history of higher than average failure rates in that specific category. Certain laptop models and specific appliance brands have measurably worse reliability track records, according to Consumer Reports' annual reliability surveys. And the warranty price itself is a small fraction, generally under 10% of the product's total cost. Regulatory scrutiny of the warranty and service contract industry has increased in recent years. Multiple state attorneys general and insurance regulators, including in California and New York, have brought enforcement actions against warranty administrators and dealership finance offices for deceptive sales practices, including misrepresenting coverage terms and failing to clearly disclose that a service contract is optional and not required to finance a purchase, particularly in auto lending. The Consumer Financial Protection Bureau has separately flagged add-on product sales tied to auto and retail financing as an area of ongoing consumer complaint volume. Consumer Reports summarized the entire economics of this industry in a single line repeated across years of their buying guides. If it were a good deal for you, it wouldn't be a good deal for them. That sentence contains the entire mechanism. Every dollar the warranty is priced above its expected claims cost is a transfer from your anxiety to their profit margin, calculated, tested, and refined over 50 years of retail behavioral data. Tool 1. The 3-question framework, applicable in the same 3 seconds the cashier gives you. Question 1. Could I absorb the full repair or replacement cost today without financial hardship? If yes, skip the warranty. You are the insurer of last resort for yourself, and self-insuring is almost always cheaper. Question 2. Does this specific product or brand have a documented reliability problem? If no, skip it. Question 3. Is the warranty price under 10% of the purchase price? If it fails any one of these, the math almost never favors buying. Tool 2. Before any major purchase, check your credit card's extended warranty and purchase protection benefits, a 5-minute lookup that can eliminate the need for a paid warranty entirely. Search Your Card Name Benefits Guide or call the number on the back of the card and ask specifically about extended warranty coverage and purchase protection against theft or accidental damage. Many premium and even mid-tier cards from Chase, American Express, and Citi include both benefits automatically at no additional cost for purchases made on that card, coverage that stacks directly against what you're being offered to pay for. Tool 3. Check the specific product's reliability data before you're standing at the register, not after. Consumer Reports publishes annual reliability surveys by brand and category based on member-reported failure data, covering laptops, televisions, major appliances, and vehicles. If the specific brand and model you're buying has a documented above-average failure rate, that changes the warranty math meaningfully. If it has an average or better reliability record, which is true for most major brands in most categories, the warranty is very likely priced above its actual expected value to you. Tool 4. Build a self-insurance fund instead of buying individual warranties. The math here is straightforward. If you decline every extended warranty offered to you across a year, and instead set aside the equivalent dollar amount in a separate savings account, you are almost always better off financially, because you're pooling risk across all your purchases the same way an insurance company pools risk across all its customers, except you keep the difference between what you'd have paid in premiums and what you actually spend on repairs, which history shows is usually substantial. 4 tools. Fast. 1. The 3-question framework. Can I absorb it? Is reliability actually bad? Is it under 10%? 2. Check your credit card's built-in coverage before buying anything new. 3. Check Consumer Reports reliability data before you're at the register, not after. 4. Build a self-insurance fund with the money you'd otherwise spend on warranties. These 4 tools cost nothing and take minutes. The warranty industry generates $50 billion a year on people who skip all 4. The warranty upsell persists for a reason distinct from every other mechanism in this series. It doesn't rely on hidden information or algorithmic tracking. It relies entirely on timing a fear-based question at the one moment you're least equipped to answer it rationally, right after spending money, right when you're imagining loss. Every other episode in this series has required a system to hide something from you. This one only requires asking you a question at the right second. That is what makes it so durable and so cheap to run. 12 episodes. Paint, glasses, mattresses, beer, store brands, prescription drugs, hidden fees, loyalty penalty, salary compression, grocery store architecture, dynamic pricing, warranty upsells. 12 completely different systems, 12 completely different industries, and every single time the same underlying architecture. A moment engineered to feel like a free choice, a profit margin hidden inside the framing of the offer, and a person, right now, somewhere, saying yes to something they didn't need to buy, legally, quietly, continuously. Final summary. Fast. 1. Extended warranties generate an estimated $50 billion annually in the US, built on gross margins of 40 to 80%, often higher than the margin on the product itself. 2. The entire mechanism rests on loss aversion, described by Kahneman and Tversky in 1979. Losses feel roughly twice as painful as equivalent gains. 3. The offer is deliberately timed after you've already emotionally committed to the purchase, exploiting the commitment and consistency principle. 4. Consumer Reports has recommended against most extended warranties for over a decade because most product failures happen either during the free manufacturer warranty or after the extended one expires. 5. Fine print exclusions, accidental damage tiers, cosmetic damage, wear and tear discretion are where most denied claims originate. 6. Many credit cards already include free extended warranty coverage you may be paying to duplicate. 7. The 3-question framework. Can you absorb it? Is reliability actually documented as poor? Is the price under 10%? Takes the same 3 seconds the cashier gives you. The warranty was never about the product. It was always about the moment you were asked. Episode 13, and this one is going to change how you look at every subscription service you currently pay for and have completely forgotten about. Because we're going into the subscription economy, the deliberate design of free trials, auto-renewal defaults, and cancellation friction that generates billions of dollars a year from people who meant to cancel and simply never did. We're going to show you exactly how many subscriptions the average household is quietly paying for right now, and it is a significantly higher number than you think. If this video changes how you answer the next warranty question you're asked at a register, hit subscribe and the bell. And share this with someone who says yes to every protection plan out of habit without ever doing the math. Because the 3-question framework takes exactly as long as the offer does. The 4 tools are in the pinned comment. They cost nothing. The industry generates $50 billion a year from people who never asked. See you next week. One specific ask. Think of one person in your life who says yes to every warranty, every protection plan, every add-on, out of habit or anxiety, without doing the math. Send them this video before their next big purchase. Tell them the pinned comment has the 3-question framework, and it takes the same 3 seconds the cashier gives them. That's a direct, immediate saving the next time they're standing at a register.